As of May 2026, inflation is stuck at a stubborn 4.2%, and a brand new Federal Reserve Chairman, Kevin Warsh, has just taken the helm. The market is actively testing the central bank's limits. Right now, retail capital is heavily concentrated in a massive semiconductor and AI rally. Many investors assume they are safe, using put options and bearish leveraged ETFs as their downside protection. This brings us to a critical question. Should you rotate out of the dominant AI investment thesis? To find out, we are going to run your portfolio through a 4-level stress test, built directly from the real-world experiences of 4 investing legends. Identifying structural flaws in a strategy before the rules of the game change is the only way to navigate this volatile transition period. We begin at level 1, the systemic threat. In the late summer of 1987, Alan Greenspan succeeded the inflation hawk Paul Volcker as Fed chairman. Less than a month later, Greenspan unexpectedly hiked interest rates. Legendary macro trader Paul Tudor Jones noticed the market structure was growing dangerously fragile under this new pressure. This diagram represents a hidden trap called portfolio insurance. Investors thought they could hold their stocks and automatically hedge their downside by shorting index futures. They blindly assumed that endless liquidity would always be there to execute their trades. But when the market started dropping, those computerized programs all tried to sell the exact same futures simultaneously. The exit doors jammed instantly. Selling triggered more selling, creating a devastating feedback loop that culminated in Black Monday. Because Jones saw the structural failure coming, he shorted the market and walked away with $100 million. The similarities to our current environment are striking. Modern derivatives and hedging tools cannot be relied upon in a true liquidity crisis triggered by a sudden policy shift. Moving down the pyramid, we hit level 2, the psychological threat. In the spring of 2021, the market and the Fed were completely aligned, insisting that rising inflation was a temporary supply chain glitch. But Stanley Druckenmiller looked at the sheer volume of stimulus and realized the inflation narrative was entirely wrong. He warned of a raging mania across all assets, but resisted the immense temptation to chase the final 6 months of that tech rally. Decades earlier, during the dot-com bubble, he let the fear of missing out break his discipline, causing him to buy the peak and lose $3 billion. He refused to let his own emotions trick him twice. By maintaining his discipline and stepping away from the euphoria, he avoided the brutal 2022 decimation that wiped out the tech sector entirely. Building this analytical mindset to spot risks before they strike requires the right tools. That is why we created the SFA Free Stock Investment Masterclass. It is a comprehensive training program designed to teach you how to stress test your portfolio. You can claim your free spot right now using the link in the description below. Knowing your absolute maximum downside and having the strict discipline to walk away is the ultimate line between market survival and total financial ruin. That brings us to level 3, the valuation threat. In late 2008, following the collapse of Lehman Brothers, the financial system was experiencing a severe credit panic. Most managers were cutting losses and praying. Seth Klarman took the opposite approach. Searching for absolute capital protection, he aggressively bought the senior debt of Ford Motor Credit, which was trading at deeply distressed prices of 40 cents on the dollar. This chart illustrates Klarman's worst-case math. He proved that even if a second Great Depression struck, causing a spike in defaults, the underlying assets would still liquidate at 60 cents. By buying at 40 cents, he mathematically guaranteed a profit, even in a worst-case disaster. Apply that logic to your holdings today. If venture capital funding dries up tomorrow, what is the absolute bottom for the AI stocks in your portfolio? If you cannot calculate that number, your portfolio is being priced by emotion, not value. Finally, we reach level 4, the fundamental threat. Legendary short seller Jim Chanos built his career exposing paper profits, famously digging through complex accounting to predict the collapse of Enron. Today, Chanos is pointing that same analytical lens at the massive AI infrastructure build-out, sounding the alarm on a ticking depreciation time bomb. Corporate giants are spending billions of dollars buying GPUs to build data center networks. On their balance sheets, they are capitalizing these massive expenses and depreciating the hardware over a generous 6-year useful life. This line graph compares that slow, steady 6-year accounting path against the reality of technological innovation. Because new hardware architectures are introduced annually, these chips face a rapid obsolescence cliff, becoming economically outdated in just 3 years. If these infrastructure companies are forced to adjust their books to reflect this accelerated 3-year reality, their reported profitability will evaporate instantly. You must look past glamorous secular growth stories. Verify whether the underlying corporate earnings driving your stocks are backed by hard cash flow or merely propped up by fragile accounting illusions. Evaluating systemic fragility, psychological traps, valuation floors, and accounting quality provides a professional lens through which to view your current holdings. So, should you switch sides? Auditing every single AI position against these 4 risks immediately will separate genuine value from fragile sentiment. We are navigating an era of sticky inflation and shifting central bank policy. This volatility serves as a critical window of opportunity to clean up your portfolio and position yourself for the next cycle. Do not navigate this critical transition alone. Click the link in the description to claim your free seat in the Stewardship Finance Academy Masterclass today. Get the right frameworks, manage your downside risk, and take control of your financial future before the market decides it for you.